Two people start with the same money, same income, same city, same opportunities. Nothing special. And still, 20 years later, their lives look completely different. Not because one of them was smarter, not because one got lucky, but because of one decision. That looks obvious at the beginning. And if you're honest, you already know which one you would choose. And the worst part? You've probably already made that choice without even realizing it. Because the most dangerous thing in investing is not losing money. It's the illusion of being right too early. Let's make this real. Daniel and Alex both have $50,000 saved. They both earn around $55,000 a year. Same starting point. No advantages. No shortcuts. Just one decision. Daniel buys a rental property. $250,000 house. 20% down payment. 30-year mortgage at 7%. His monthly payment is about $1,330. He finds a tenant willing to pay $1,800. On paper, that's $470 a month. And that number feels convincing. It's clear. It's immediate. It looks like progress. Alex does something that feels almost boring. He invests the same $50,000 into a total market index fund, then sets up an automatic contribution of $300 a month. No strategy, no timing, no excitement. Now pause. One of them owns a house, a real asset, a tenant, cash flow, control. The other owns numbers, numbers that move, up, down, sideways. If you're honest, you would choose Daniel, because it looks like you're moving forward. And that's the trap. The first year goes exactly how Daniel expects. Rent comes in, mortgage gets paid, nothing breaks, nothing goes wrong. Everything confirms the decision. And that's what makes it dangerous. Because when something works early, you stop questioning it. Those $470 start to feel like proof. But they're not proof. They're projection. Because that number exists before reality shows up. And reality always shows up. At first, it's subtle. Property taxes, $3,000 a year. Insurance, $1,500. Maintenance, let's be conservative, $2,000. That's $6,500 a year. About $540 a month. Now, go back to the beginning. That $470 profit never existed. You're not making money. You're covering a gap. And if you've ever looked at rent and thought, that's easy money, this is exactly where the illusion starts. And most people don't notice this. Because income feels like progress. Costs stay invisible. So the story survives. Then 1 month breaks the illusion. No tenant. No rent. But the mortgage is still there. $1,330. Gone. Add cleaning. Listing. Minor repairs. Another $800. That single month just erased more than a year of profit. Then something breaks. A water heater. $1,200. Later, a roof leak. $2,800. Eventually, something bigger. An HVAC system. $7,000. Not optional. Not delayed. Not negotiable. And here's the part that matters. These costs don't arrive evenly. They come in waves, which means you never feel the full cost at once. You feel fragments, and your brain fills the gaps with optimism. You remember the rent. You ignore the outflow. After 3 years, Daniel has collected about $64,800 in rent. That sounds impressive. Now, run the full picture. Mortgage payments, $47,880. Remaining, $16,920. Still looks good, until reality finishes the calculation. Taxes, $9,000. Insurance, $500 repairs and maintenance, $6,000 to $8,000. Vacancy, $800 turnover costs, $600 to $1,000. Now step back. That $16,920 becomes roughly $2,000 to $4,000. Total, not per year. 3 years. And this is the moment most people miss. Because it still looks like you're ahead. That's the gap between perception and reality. And none of this even includes the late-night calls, the lost weekends, the stress. This is where the illusion should break. But it usually doesn't. Because Daniel still looks ahead. He has something real. He can point to it. He can talk about it. Alex has nothing to show. His $50,000 becomes $55,000 in year one, $61,000 in year two, $68,000 in year three. Nothing dramatic, nothing impressive, no story. And that's exactly why most people quit here. Because one system feels active and the other goes unnoticed. Daniel looks like he's winning. Alex looks like he's doing nothing. Both are wrong, because neither of them understands what their system actually does over time. Daniel is buying control. Alex is buying compounding. And those two systems behave completely differently. Control gives immediate feedback. Compounding gives almost none at the beginning. And a lack of feedback feels like failure, even when everything is working. By year 5, Daniel is fully inside the system. Tenants, repairs, messages, problems. It looks like progress, but strip away the feeling and look at the numbers. His real return after everything? About 3% to 5%. Not the 15% he imagined. Not the passive income he expected. This is not passive. It's active, and it scales with effort. Now look at Alex. $50,000 initial investment. $300 a month. That's $18,000 added over 5 years. Total invested, $68,000. Portfolio value, roughly $90,000 to $100,000. Still underwhelming. Still easy to doubt. But something is changing, quietly. The growth is starting to compound. Not obvious yet, but building underneath. And this is where most people quit. Not because it doesn't work, but because nothing signals that it's working. By year 7, the shift happens. Alex's gains begin to generate more than his contributions. That's the moment everything changes. Because now the system no longer depends on him. Daniel can grow too. But for him, growth requires expansion. Another property, another loan, more responsibility. His system scales with complexity. Alex's system scales automatically. And that difference compounds over time. By year 10, from the outside, Daniel looks successful. His property is worth roughly $335,000 to $350,000. Remaining mortgage, about $166,000. Equity, $170,000 to $184,000. That feels convincing. But here's what most people don't calculate. To get there, he didn't just invest $50,000. He also absorbed everything else. Repairs, vacancy, unexpected costs. Over 10 years, that's another $20,000 to $35,000. Out of pocket, plus hundreds of hours of effort. Now compare that to Alex. Total invested, $86,000. Portfolio value, $165,000 to $180,000. The difference? No friction, no interruptions, no hidden costs. At this point, they are close. And this is where most people make the wrong conclusion. They think real estate wins. But that's not what the numbers say. The numbers say they end up in the same place. But they didn't pay the same price to get there. Daniel concentrated everything into one asset, one property, one location. Alex spread his risk across thousands of companies. Different industries, different outcomes. That difference doesn't show early, but it shows later. Now here's the part nobody expects. Fast forward to year 20. Daniel's property is worth $450,000 to $500,000. Mortgage nearly gone. Equity, $400,000 to $500,000. Now include everything. Maintenance, repairs, vacancy, taxes, insurance. Across 20 years, total net cash flow profit, $40,000 to $80,000. Total. Now look at Alex. Same start, same discipline. $50,000 initial. $300 per month. At 10% average return. Portfolio, $420,000 to $460,000. Total contributions, $122,000. Everything else? Compounding. Over $300,000 created by time. Now step back. They end up in the same range. $400,000 to $500,000. Same result. Completely different cost. Daniel traded time, effort, and complexity. Alex traded patience. Which system can you actually follow for 10 to 20 years without breaking it? Because the biggest risk in your financial life is not the market. It's not tenants. It's not interest rates. It's you. And if you ignore that, it won't matter what you choose. Because the system only works if you stay in it.